Hello and welcome to episode 6 of Weapons of Mass Construction. Today we're going to be talking about banking relationships, how to develop and hopefully maintain them. So I'm Bob Teska. I'm the partner in charge of construction services here at Bowers & Company, and I am joined by my friend.
Hey Bob, Larry Alampi. I currently run the business development group at CH Insurance. It means a lot of things these days. So I maintain my own commercial book of insurance clients. I also focus on growing and managing our network of COIs, which are bankers, CPAs, attorneys. And in that role, we're looking to expand some markets. We're looking to get into the Rochester market, the Buffalo market, the Albany and Saratoga market. And lastly, I do a little bit of loan consulting on behalf of CH for their clients and prospects.
Awesome. So at this point, I'm pretty sure listeners are wondering why we're talking to an insurance guy about banking. So perhaps you can enlighten them.
Sure. Prior to being at CH, I actually was a 20-year banker myself. Most of that time was spent as a commercial lender. So I have the ability to pull back the veil a little bit and kind of give you the look that not too many other people get. So
awesome. So we're going to get an insider's view here today, and no one's going to prison. All right, so here are topics we're going to cover. We're going to do this more in a conversation than a lecture format. So let's get going here. All right, I'm a contractor, which contractors in general aren't always a banker's best friend.
True.
I've definitely had some Dear John letters sent to a couple clients from banks they've been with a long time. So how do I, as a contractor, find the right bank to meet my needs?
Well, luckily, there are a lot of banks in central New York. I would probably recommend the best thing to do is use your network. You know, who are like-minded contractors? Who do you work with on a day-to-day basis? Usually their experience will give you a good tell whether they're at the right bank, and the referral network is always the best way to do it. You'll understand if a bank is in or out in the market segment, and I think that's really your best way to figure out if it's a contractor-friendly bank, if you will.
Gotcha. All right. So one of the items that a contractor needs, obviously a lot of companies need a line of credit. But for a contractor specifically, there's usually some size of a line of credit they need as mandated by the surety company because they want the contractor to have a little bit extra working capital if needed to be able to tap into it. They should say they want them to have it. They don't want them to use it.
Sure.
So when you have this line of credit, looking at what you've seen in your experience, what's the bank looking at when I go and I apply for that line of credit?
First and foremost, it's your financial wherewithal. What does your commercial financial snapshot look like? What does your personal financial snapshot look like? How do you handle your credit? They're going to look at how you manage your accounts receivables, how you manage your accounts payables. It's all going to be put together to kind of give them a picture of who you are. How do you manage that type of thing? Are you credit worthy?
So I guess to take that a step further, if I'm a pass-through entity, so I'm an S-Corp, an LLC, they are going to look at my corporate credit as well as my personal credit.
Correct. Your personal is always going to be looked at. How much it's weighted, that really depends on where you are. But if you can't handle your own affairs, you probably can't handle the affairs of the company, right?
And 9 times out of 10, we're going to be asked for a personal guarantee, correct?
9.9 times out of 10. Let's go with that. That was always a hot button back in the day. I think personal guarantees are one of those things. I mean, in some very, very one-off instances, if you maintain an enormous relationship at the bank, your deposits are heavy, you have the plethora of products, there may be a conversation, but I would tell you that you should walk in expecting to, sign that piece of paper and give them your personal guarantee.
Yeah, I mean, that's been my experience. I think within my client base, I might have 2 clients that don't have a personal guarantee,
right.
And that's because their balance sheets are bulletproof. They've got net worth in the 7 figures, and they really don't need the line of credit. It's just they have to have it to make the bonding company feel warm and fuzzy.
Right. I mean, there's no risk, right? I mean, I hate to say that. There's always risk, but essentially, there's no risk.
Correct. All right. So, best and worst uses for your line of credit.
Rule number 1, don't go buy the F-350, right? We joke about this. You and I have talked about it. You know, the best use for your line of credit is short-term capital. You know, do you need to fund your accounts receivable? Do you need to, you know, get material for a job? Do you need to cover some seasonality in the industry? You know, anything that you take in that's relatively short-term, that's what your line of credit is used for. Worst uses, we talked about it. Don't buy the flip house. Don't buy the F-350. Don't buy a building.
Or a restaurant.
Or a restaurant. Now, I say that a little tongue-in-cheek. If you have the means to quickly put that into a long-term financing arrangement, that's fine. If you need to just scoop up the property and in 20 days you know you can take it out and go long-term and put a term loan on it, that's fine. Don't carry it for the entire calendar year.
Right.
The bank does not want to see that you are funding your operations with a line of credit.
Yep. So that kind of leads into, you know, what is a covenant? And, you know, there's a lot of different covenants out there. One that you see all the time is they want a 30-day pay down. There could be debt to net worth ratios that they're looking at, or just a net worth ratio. I don't know, describe that maybe, why they're there, what happens if you don't meet them.
Sure. So a covenant is very simply the bank's way out, right? It's a way that they manage the usage of your credit. If you blow a covenant, you know, they have the opportunity to say we're done. You know, they can walk away. 30-day is probably one of the most common you're going to see on a bit of a larger line of credit. And what that is that's just showing the bank that you can come out of the line of credit, meaning you're at a zero balance for 30 consecutive days. And what that does is prove to the bank that you're not funding your operations. You're not running the company on your line of credit. In terms of blowing a covenant or not meeting a covenant, full disclosure to your bank, to your banker, let them know that this is upcoming, work with your CPA. You guys can talk about, you know, what those ratios may not be or where you might fail. Give your bank a heads up and let them know that it's coming. And they usually, you know, I say that a little loosely, but they usually will make an exception, right? I mean, if it's a constant violation year after year, you're going to have a problem.
Yeah. So like from our end on the financial statements, we actually have to disclose if the covenants fail.
Correct.
And then also the bank's response, right? Because technically, as you said, if the covenants fail, the bank can call the note today. You got to pay it back today.
Sure.
And so that could be material to the financial statement, yada, yada, yada. So we then have to let the bank know before we can issue the financial. We usually send them a draft.
Yep.
And we say, hey, here you go. We failed this covenant. Will you issue us a waiver?
Correct.
And a waiver is just that, right? They basically turn a blind eye to it. Say, yeah, we could call it, but we're not going to.
We acknowledge that it, you know, that you didn't meet it. We're comfortable with the handling of it and the go forward plan, and you know, we'll move forward. However, it's likely going to cost you,
right?
And oftentimes there's going to be a fee associated with that waiver, with that covenant waiver.
Right. And it seems that, you know, the smaller lines might not have a waiver fee, but the larger the line you get, typically the larger the fee that there's going to be.
No doubt. And again, that's, you know, when you're at a certain dollar amount, there's different eyes that are on those credits. The larger you go, there's more people looking at it, right? I mean, that's the bank's capital, and it's supposed to be used properly, so people are watching it.
Yep. All right. So talked about line of credits, you know, current liability. Now we've got equipment term loans. From my perspective, banks kind of like equipment loans, correct?
They love them for one reason. It's tangible collateral. You know, you buy that backhoe, you don't pay, the bank's coming to get it, right? I mean, that's as simple as that. Much more flexibility with, you know, with a hard asset that's used as collateral. A line of credit is, you're going on history and projection and your proper handling. But banks do love hard collateral for sure.
Yeah. I've seen people struggle to get a line of credit, but have no problem getting an equipment loan because of the collateral piece.
And it's generally short-term in nature, right? It's amortized. You know what it's going to be, payment X, Y, and Z, and then it's done.
Right. All right. So looking at both term loans and the line of credit, what's going to affect the interest rate on your loan?
Interest rate is one of those interesting pieces in the banking world. Some banks operate on a formulaic approach, you know, based on a certain dollar amount, based on a certain scoring model that they use, you're going to get X. That will be your rate. A more sophisticated bank or a larger credit relationship, again, the relationship is going to come into play. What do you have? What are you bringing to the table? There's going to be some leverage in there in terms of what you'll come out at from an interest rate perspective.
What about, I'm shopping for a new bank, for whatever reason. Maybe I'm buying the company from the current owner. I'm a long-term employee. I'm now going to buy this company. There's probably the current owner is going to hold some paper, but he wants to cash out somewhat, so I've got to get a loan from a bank.
Sure.
So obviously that type of loan is going to be a little different. And in that situation, do you see using like an RFP process where we're going to multiple banks with the offer for them to propose on it to us?
Well, yeah. The old owner has the relationship, correct? That's sort of how we're going to say.
Mm-hmm.
So I would always bring that bank into play.
Sure.
That's always the first place you're going to go. They understand the business. They understand the operations. And quite honestly, if the old owner is going to remain in some capacity, it's a nice segue.
Right.
Now, if the relationship is going to be completely anew and he's out and you're starting fresh, you want to keep everybody honest. I'm not saying to shop every bank that you know,
right,
but use the network, talk to your CPA, talk to your lawyer, find out, maybe they have relationships. Leverage those relationships because new business to a bank is very, very desirable. And you're going to usually get an aggressive deal, if you will.
Right.
I say that again, a little tongue in cheek. All of the stars have to align, right? It has to be a good deal.
All right. So when will a bank not give me a loan?
Quite simply, if your financials are crap, probably not going to get any money, and that's consecutive losses, that's negative retained earnings, that's poor personal credit management. All of those things, as we talked about, are a snapshot. And every piece of that puzzle that's missing gets you closer to a decline.
Sure. What about, economic uncertainty in the economy as a whole? Will a bank change their credit policies at that point, pull back, whereas in better times they might be a little more lenient?
Sure. And, you use contractors as an example. We've seen times over the last 20 years where I don't think a contractor could get a loan.
Mm-hmm.
It was a bad time for a lot of people. Credit is always industry, economy driven. Banks are hot, banks are cold, but that's the important part of having a relationship and maintaining a relationship.
Gotcha. And I guess just lastly here, when's it time to find a new bank?
Couple of reasons. One, they're not living up to their expectation. They're slow in response. They do a poor job of, keeping in touch. They are slow in terms of a credit request. You need something, you're not getting what you need. It's certainly a time to start looking around and finding something new. We go back to, the first question. Maybe you're in an industry that's a little bit cold in terms of banking. Use your network. Find a bank that's not so cold. They're going to be a little bit more apt to take on that new relationship and give you a little bit of a better opportunity. But it's important to maintain a solid relationship with your bank.
Right.
No doubt about it. Full disclosure, be honest, be open, be upfront. And, there's a lot of good banks and a lot of good bankers in our area.
Mm-hmm.
So do right by them and they'll pretty much do right by you.
Yeah, I think, with anyone who's extending credit, really any of your advisors, right? I think over-communicating is a whole lot better than trying to hide things because eventually it's going to come out.
You can't hide.
If in September you're telling your bank that things are going great, even though they're not, because you don't want to start to answer questions, eventually your financials, the tax returns are going to get done. You're going to have to submit them, and the cat's out of the bag.
Correct.
It's far better, in my opinion, to let them know up front, hey, we're struggling this year. Here's our plan. Here's why, and here's our plan. And that's going to go, I feel, a whole lot further than, just dropping a bomb on.
No question. And, shameless plug for you, I think that's where it's really important to have the right team around you. I've spoken to as many CPAs as I have business owners in terms of a relationship.
Right.
Oftentimes, you can connect those lines directly.
Mm-hmm.
The customer can almost step aside, and you and I can have the conversation.
Sure.
It's a lot more open. It's a lot more frank. And you just don't want to be blindsided as a banker.
Yep.
You don't, because all bad comes from that. I mean, truly. And you know, you're gonna find yourself in a position where you don't have the means to run your business and to grow.
All right. I think this was pretty productive. Thank everyone for attending. We do not have contact info. So contact info was on this slide. So any additional questions, feel free to reach out by phone or email to either one of us. We'd be glad to touch base with you.
Yeah.
Thank you, and we'll see you for episode 7.
Thanks a lot, Bob.
Yep.